a lot of traders get caught up in the labeling game and trying to just mark things correctly and not realizing that maybe they're all the same thing. And what I mean by that is when I'm comparing a head and shoulder pattern, which is just left, head, right, that can look like a distribution from a Waqar theory perspective, just a bit more detailed.
Correct.
And then you can probably have an ICT variation of that with its own turtle soup name. And then I can justify it in another way because I'll be looking at something else more sweep related and rejection related. Point being, we can all see the same price action and one person marks it as a head and shoulder, another person marks it as something else.
Correct.
This labeling game, do you think when people do the labeling game down on the lower time frames, where you're using a Waqar distribution, which was daily candle prints in its origination, now being done on the M15, M5 and these kind of things, do you think it's just people labeling things and it just coincidentally is aligning, or is it truth in it so that it is a accumulation distribution on a lower time frame?
That's a nice question. I wouldn't say that we're talking about the same thing, because Wyckoff was talking about accumulation and distribution of shares, of stocks. So it was literally accumulating as in buying and distributing as in selling. You're selling those stocks. So it was a long-term, let's say a longer-term pattern. So I wouldn't say nowadays the same thing is going on, the same thing that Wyckoff was mentioning or explaining. I would say that it's somewhat similar in the way it shows itself, but the reasons are different. And they are not necessarily manipulative, I would say.
So that was actually part two of my question, which is people get into the labeling game and sometimes they label it and then price does what they expected. So they're like, I figured it out. My labels were correct. When a lot of times it's more coincidental, or what I usually call is correlated. So when I see, for example, a head and shoulder pattern, I'm not a big believer in it. So when these people see the right shoulder and then it goes bearish, not only the idea of these hedge funds are not selling because of the right shoulder, they have other reasons, and your right shoulder was a nice reflection of that. So it's a correlation, not a causation. Do you believe these genesis ways of Wyckoff theory and others, they are core essences of the market? That's the reason the market moves in smart money ways? Or do you think they're nice reflections of something deeper?
So these are very complex questions to answer in a brief and concise way. I think the best way to figure this out is understanding who is in the market, understanding how market mechanics work, and understanding the reason why price may move. And as you've said, there's hedge funds, there's banks, there's pension funds, there's sovereign funds, there's university endowments, there's actively managed certificates, there's community pools operators, commodity pools operators, commodity trading advisors, there's retail traders. The amount of types of participants that are in the market makes you understand that, first of all, the finalistic view of the market, where something happens because of someone else's benefit the whole time, doesn't hold.
I think that makes a lot of sense, because what you've listed is a long list of speculative participants.
Correct.
But there's also people just genuinely using the currency for international trade.
Definitely.
The market is a sum of so many behaviors,
Yeah.
and we see that reflection in price. But
Yeah.
this macro, like one party controlling, it doesn't make too much sense when you look at it from that lens.
Definitely. And that makes you also understand that the kind of needs of every different market participant are completely different, because there's a difference between big money and smart money, for example, in the way I view markets. Because a big money participant like a pension fund is not going to try and get the best feel out of every contract they're trying to put on the market, while maybe an HFT firm or a bank will, if they're trying to be smart, as in let's try to get the best feel possible, while a pension fund maybe might get a big chunk of order of billions of dollars in the same market all at once, maybe trying to fill it below the VWAP if they're really, but I highly doubt so. The point being, pension funds has a way longer time frame of holding their position. They're more investing than actively trading. So maybe some of the pattern we are seeing are some types of market participant trying to influence the market and engineer some level of liquidity, which I don't believe is retails, by the way. They're not
For sure.
They're not hunting for retails for sure.
Yeah.
But definitely, physiological needs are different based on what kind of market participant you are.
So this is a topic I don't have an answer for myself, and I always try to explore it with a guest, and I don't think anybody truly knows, because I get different answers from everyone. But when we're kind of referencing Wyckoff theory, and let's use the example of accumulation. Accumulation, in the true sense from a Wyckoff perspective, is over time, the market is shifting from bearish to bullish, and we're entering a new market cycle. For a transition of meaning to happen like that on such a large time frame like the daily, it requires a lot of money to transact. And the reason I think that happens is because one person can't come in and just say, I want to buy at this price at this time all of this amount of currency. So they have to slowly ladder it in when liquidity becomes available.
Correct.
So that display we see of accumulation is the behavior of the market changing. So when I see on a lower time frame, which was the earlier question, I'm seeing that as, okay, why is M15 accumulating? And it looks exactly like the Wyckoff version, and I can label it out. And I think to myself, am I doing the labeling game, or is there true essence in this? And then I fall back on logic. I'm like, well, maybe so, because, okay, we're not talking trillions or tens of or hundreds of billions of dollars, but on the M15, we're still talking a lot of money.
Yeah.
And that guy can't come in and just say, I need to buy at this time, at this price, all of this. So I have to wait for the liquidity to become available so I can pair off my order. So I was just seeing them as like mini versions of it on a smaller time frame, meaning smaller dollar amount. Transactional. But then I come back to the same point of who is it? Because when you're talking about these major participants, they're probably not microscopically on the M15. They're putting in a big position, taking a few weeks for it to fill, and then waiting 10 years.
Correct. Like the point is here, we're not talking about practical implementations as much of opinions, I would say, because right now we're in the realm of opinions. We're in the realm of trying to understand why things happen, which is not always helpful in trading, I would say. Like, I would say that for a rational and logical mind, knowing what's going on and why is it going on is very helpful to understand the logic. But if you're a pattern-based trader, you're not going to give a shit about why is it happening, as long as it's happening with a statistical edge, which is enough.
To be honest, I end up there. I'm like, okay, I don't know why, but I have enough evidence. I can build an edge, so I'll keep doing it. I do the behavior and not truly understand when I see a run of liquidity and then a rejection, and you probably see the order flow behind it. So you can see the evidence there. But the whys of it, I guess we leave it to a mystery. But that leaves a big void for ICT to come in and say, it's the algo. It's the algo I coded.
100%.
And then you're left confused because you can't deny it because you don't know the truth yourself or an explanation.
You can deny it because, and I would argue that there is a level of depth in which you can go with understanding market mechanics. The more you understand the truth of how market works, you understand that it's a very complex mechanism, and you start embracing uncertainty in understanding. You start understanding that you're not going to understand, and that's okay. And if the more labels you try to give, the more you're based on opinions. And this is the whole thing about the ICT space. I've heard a lot of ICT, not a lot, honestly, but some ICT traders, not ICT himself, talking in some podcasts about the algo and how there is central banks, so it's supposed to be a central bank one, but also it's the banks that doesn't have access to it, so it's like above banks but below central bank. That's like a very creative work, I have to say. Okay.